Thank you for joining me for our review of the first quarter for 2017. After publishing our Global Outlook and Strategy document, which is on the website, I thought I'd give you a brief overview of our current investment stance. We believe that we're going through a period right now with very much heightened risks. Post-Trump rally in markets and very accommodative central bank policy has left valuations very full in our view. And this is a time when there's increased geopolitical risk, whether it be in the South China Sea or the policies out of the newly elected president. However, there is some positives. Global growth is starting to pick up and there is signs of reflation as opposed to the deflationary environment we undertook over the last few years. This, however, will come with the risk of rising interest rates, which will put pressure on valuations, particularly since we've got high global debt levels. And we've also got a secular trend whereby in developed economies we have an ageing population and a shortfall in pension schemes, and also the masses are very unsettled. So the key message that I'd like to leave you with at the moment is that we believe patience and diversification is a key in such an unknown environment. We would retain a healthy level of cash within portfolios to take advantage of any weakness that we may see in markets. We are reducing our property exposure after a very good performance over the last number of years. We're neutralising our overweight to overseas equities, and we're increasing our alternative exposure. Within direct equities, global PEs are quite elevated, particularly in the States. In global markets, PE at the moment is around 16 times versus a 10-year average of 13.8. Our US equity market over the long-term cyclical PE is running now at around 24.5 times, which is one standard deviation above average. The Australian Chiller PE, which is a 10-year average of earnings, is trading at around 15.3 versus 14.7. So really we need earnings growth to justify these sort of valuations. Dividends, however, are still attractive and above bond yields. The Australian equity market has underperformed international markets for over 5 years, and that is why we're bringing some of those funds back from offshore into the Australian market. And all of this is coming at a time when complacency is very high. The VIX, which is a measure of complacency and investor fear, is now at record lows. So we think that could be vulnerable to a pickup and a correction in markets. Within property, residential valuations and residential values by any measure are stretched and vulnerable to a correction, particularly in the apartment market, which is well documented in the press. The Australian REIT market is also quite expensive in our view, trading at a 25% premium to the NTA and with cap rates now around record lows of 5%. So the potential returns we see in A-REITs is a maximum 6.5%, and we believe that you're not being adequately rewarded for the risk, particularly given the premiums to NTAs. We prefer niche sectors in the direct property area, medical centres, or distressed properties where the manager can add value. Within fixed interest, we're seeing the reflation trade where global growth is picking up and therefore bond yields are rising, which means you have a lower price. Bond funds, for example, were only up around 2% for the last year, underperforming cash. And in the US, the bond index was down 7% for the quarter. That is why we're retaining a zero weighting to bonds and prefer cash as our defensive allocation. We're cautious on high yields within credit. Credit spreads are back to GFC lows, and we are cautious on that market, particularly at a time when credit quality is deteriorating and debt levels once again are rising. We prefer the senior loan market, and within hybrids, we have an allocation to a number of bank hybrids, notwithstanding that we allocate that out of our equity holding rather than our fixed income. Within alternatives or other markets, we're increasing exposure to private markets, private equity and private debt. Within hedge funds, we like market neutral funds and global macro funds. And we're looking for diversification and non-correlated funds to dampen the volatility that we expect out of listed markets. So in conclusion, we believe that risk assets are vulnerable to a correction. We think new funds into the market should be gradually implemented. We believe that patience is the key and having a high level of cash to take advantage of any pullback. You'll be very selective in investing. Capital preservation is the key, and patience and diversification is what we recommend. I'm also delighted to announce that Will Porter has relocated to London as our Global Head of Research. We felt it was very important in these times of heightened risk and uncertainty to have someone on ground in the investment capital of the globe seeking input from international fund managers and international markets. We believe this will give us greater insight into navigating these very difficult times on behalf of our clients. For a full report of our outlook, please see our website. Thanks for joining me.